Dhiraj Agarwal is co-head equities at Ambit Capital. He's joining us now to take some questions. Dhiraj, good to have you with us here. Thank you very much for your time. We've had a decent move, 1,000 points or so from the lows of March. What next in the medium term is the question. What is your own assessment? Markets in the last couple of days have also become quite very quiet, not just here, but globally as well. But directionally, how do you see things?
So I've said this, I think, a few times before on the channel that we see this still as a range-bound market. Not too much of upside, not too much of downside. And every time the market makes a move, like you said, 1,000 points from the low, it suddenly appears to be very bullish. It appears sentimentally that we can possibly take out the previous highs and keep roaring away. But then some disappointments creep in, and vice versa. When it falls, it looks like the world is coming to an end. But that's also not the correct picture. We see the market continue to range trade for a while more.
Okay, the market could continue to trade in a range for a while more. What are we looking at in terms of individual sectors, Dhiraj? There's a lot happening now. Autos have come back in a big way. Technology has taken a backseat. Banks continue to be over-owned. In terms of a sectoral allocation, what's the best bet?
So, in some senses, sectors also rotating within a trading market, right? But one very important phenomenon of the last few months, or last couple of months especially, is the crash in the WPI index. And now WPI is almost 450 basis points below CPI, which basically means that the huge headwinds that we saw in a number of sectors last year in 2022 and parts of 21 in terms of margin headwinds, because the input costs were rising faster than companies' ability to pass on the price increases, is now reversing. For a number of sectors, with WPI now being 450 basis points below CPI, the input cost is now softening, whereas people are not cutting the end product prices fast enough. So a few sectors will see a positive margin bump up going forward, which could be the sectors and which could outperform. So autos, as you mentioned, is one of them which benefits actually from WPI trading below CPI. A number of other consumer-facing sectors, including discretionary or FMCG, would see some margin boost in the next few quarters. And these sectors could be, from a tactical point of view, 6 to 12 months, could be relative outperformers. Banks are trudging along. I think, as you rightly said, they are over-owned at this point, but nothing negative out there. Results are going to be fine, so they'll probably just trudge along.
All right. Hi, Dhiraj. Good morning. Thanks so much for joining in. The last time you joined in, we discussed that within sectors as well, there'll be themes that will do well. I think we spoke about Mahindra CIE, one of those stocks that were relative outperformers. And we also discussed, banking name SBI. If it corrected from the top, then it's giving you a good entry opportunity. If any stocks that you all will be looking to add in this recent fall that we saw, we've seen a good recovery, but any such names that you could share with us?
So, usually I don't go deeper into individual stock levels, but within the banking sector, we like Axis, ICICI and SBI, Axis, SBI and ICICI in that order. Autos, our top picks are at this point Eicher, Tata Motors, etc. So, that's the whole drift. Markets will continue to range trade between roughly 16,000 and roughly 19,000. Sectors would see sharp rotation, as we have seen in the recent past. IT outperformed for almost 6 months, and then suddenly in the last month and a half, they are looking like one of the worst performing sectors YTD. So it's going to be a tough market, at least for another year or 9 months.
Okay, you said in autos you like Tata Motors and Eicher Motors. You're not looking at any of the rural, the two-wheeler guys, the passenger vehicle makers in the Indian market, something like a Maruti, M&M, Hero. I know some of these stocks have, barely recovered and are still struggling with the rural markets under pressure. But anything that you would buy?
No, I think these two remain our topics. Rural markets, rural economy, there is a lot of optimism creeping in at this point of time. To be fair, rural economy has stopped worsening at this point, but will there be a strong recovery going forward? We are slightly circumspect. Talking about tractors specifically, Now, tractors have seen almost 2 years, 2.5 years, a very strong upcycle. And it is a cyclical sector. I mean, it's never happened in the past that we have seen a strong upcycle in tractors for 3 or 4 years in a row. Maruti has its own other challenges. It by and large remains a tactical trading play, 10-15% move up and down. So the short answer is no, we prefer Maruti. We prefer Tata Motors than Eicher in this space.
Dhiraj, on Tata Motors, I mean, it's a massive commitment, right? 15 billion pounds over the next 5 years. Will it kind of reignite concerns around free cash flow, given the commitment that they are making?
It's a little bit of a chicken and egg, because one of the longer term concerns in Tata Motors always has been that while they're doing well in the short run, in the long run, do they have the product portfolio and the models and new technology to be able to stay relevant on a 5 or 10 year time frame? So there's always a little bit of what's the right thing to do, just focus hard on free cash flow and not do any product development but I think what the company is doing at this point of time is more intelligent capital allocation rather than just spraying capital all over the place. And that's one mantra which the company has followed for a while. This year and the next year, the strong FCF generation will show up on stock price performance. Longer term, the JLR portfolio has to address the concerns on the entire product relevance from a 5 or 10 year point of view.
Dhiraj, let's talk about the hottest sector for the last 10 days or so, the IT space. Some believe that this kind of a lull or this kind of uncertainty is providing a perfect entry opportunity, and they are very high quality names as well. Would you be in that camp, or would you say the pain is just starting? We have not yet seen that full-blown recession in the United States, which everyone's anticipating, and you'd rather sit on the sidelines and better opportunities will come to enter IT stocks?
I think we'll get better entry points, and just to soften some of the adjectives that you've used, whether there's a full-blown recession in the US or whether there is a mild recession or mild slowdown in the US is, I think, not that much of a debate at this point of time. But one thing which is looking very, very clear is there are budget cuts. Companies, especially in BFSI, retail communication, are scaling back spends. And that will impact IT companies' growth going forward. We have already seen signs of that in this quarter results, which has come so far. This will only accelerate going forward. So just to look at the growth numbers versus valuations, IT sector growth is moderating now to almost pre-COVID levels, maybe even slightly lower than pre-COVID levels. And the valuations are still trading 20-25% premium to pre-COVID levels. Between 15 and 18, 19, IT sector even traded at a discount to Nifty for a while. It's still at a premium of 15-17% to Nifty at this point. So the entire valuation readjustment to the growth moderation has not yet happened. This will play out over the next 2 or 3 quarters, perhaps, maybe 2 quarters if it's fast. So there will be better entry points. I mean, they are fabulous companies, free cash flow generating, cash rich, very well governed, undoubtedly. But it's simply equilibrium between growth and valuation that one is concerned about.
Dhiraj, I don't know if you've been following the troubles at Blinkit recently. It's been all over the news. I don't know if any read-through for a name like Zomato, because I mean, in that space, when people ask, well, do you like anything in the new age companies, Zomato constantly comes up as perhaps the _1 choice for many, because many see as a clear use case for it. We all use it, food delivery apps. So that is there, but any read-through from what we've seen at Blinkit?
I mean, just a quick comment. I haven't actually thought through it deeply, but any reduction in capital allocation to Blinkit is actually positive for Zomato. So I think the core food delivery business is fantastic. Grocery business is very, very challenging and could suck in a lot of capital. So it may be unfortunate at some level, but to some extent, reduction in capital allocation to that space would be positive.
Okay, we will end the discussion on that note. Dhiraj, thanks a lot. Pleasure speaking with you. And by the way, the market is also picking up pace. So perhaps you're that good luck charm that the market needed at this point.